Before I introduce the ambassador, just for his sake, I'd like to ask, how many of you speak Hungarian, just by chance? How many of you have been to Hungary? And how many of you are going to Hungary someday? There we go. Maybe after the lecture we'll have all. So I'd also like to recognize S. György Szapáry, who is the honorary consul for Hungary in Utah. He's accompanying the ambassador on what has been a very busy trip. The ambassador has had a great opportunity to see many parts of Utah, to visit the University of Utah, to be hosted by the LDS Church. And we're grateful for our honorary consul who, for those of you who are deeply interested in Hungary, and I'm sure that will be all of you after today, he is our point person here in Utah for all things Hungary. His Excellency György Szapáry was appointed Hungarian ambassador to the U.S. in 2011. He previously served as deputy governor of the National Bank of Hungary and as a member of the Monetary Council on 2 different occasions, as well as advisor to the president of the National Bank of Hungary and senior resident representative of the International Monetary Fund in Hungary. Prior to that, he worked at the IMF in Washington, D.C., most recently as assistant director. His other positions include being alternate governor for the European Bank for Reconstruction and Development, president of the board of directors for the International Training Center for Bankers in Budapest, board member of the Budapest Commodity Exchange, president of the Foundation for Enterprise Promotion of the Hungarian Province. I'm not sure I'm going to be able to hit that. Member of the Economic and Financial Committee of the European Commission and of the European Central Bank's International Relations Committee, and as a member of the Hungarian Economic Social Council. He has also been a member of the Advisory Council for the European Studies Foundation in Budapest since 2002, a member of the Euro 50 Group since 2001, a member of the Gyula Andrássy Foundation in Budapest since 2006, and a member of the Steering Committee on Public Finances for the European Commission in Brussels. The ambassador received a master's and doctorate degrees in economics from the University of Louvain in Belgium, where he was also a research assistant. We are immensely honored and look forward to hearing from His Excellency. The topic for his presentation today is the evolution of the economic crisis, how to get back to growth. Please join me in welcoming Ambassador Szapáry.
Thank you very much for this nice introduction, and it's a privilege for me to be here, and thank you for the invitation. I was very impressed with how many of you speak Hungarian, so I decided I'm going to give my lecture in Hungarian. Is that okay? All right. Since by training I'm an economist, so I picked a subject that deals with economy, and I am going to talk about a little bit about the origin of the crisis, but mostly of how the policy responses were to the crisis, and where did we get, where are we now, and how can we resume robust growth both in the United States and in and in Europe. And what was special about this crisis is represented by this slide. When the problems were perceived at the beginning, you only saw the tip of the ice. As the crisis unfolded, you realized the problem was much bigger. The crisis really started with, here in the United States, with what we call the subprime crisis, which was a very heavy borrowing for home purchases, mortgage loans. And those mortgage loans were packaged into a sort of bonds, type of bonds, and they were sold to bigger investment companies, because there are many mortgage companies in the United States. They sold it to bigger investment companies. Those investment companies, packaged it. The rating agencies gave them generally a AAA rating, and it spread around the world into financial companies around the world buying this mortgage-based investment vehicles. And so it went to Europe mostly. And when it turned out that some of these mortgages or many of these mortgage loans could not be paid back because people were over-borrowing, interest rates were very low for a very long period of time, then suddenly these assets in these packages became worthless because in some of these packages there were thousands and thousands of loans and nobody knew exactly which loan is still good and which loan is already turned out to be in default, the bad loan. So they had to be written down to zero. So immediately the banks held those assets, which we called at that time toxic assets, had to write it down to zero, and as a result, they realized a very big loss. It also led to a freezing of the interbank market, which is a very important market in the financial sector because it evens out the liquidity within the banking and financial system. It froze because nobody knew that my partner, how much bad loans it has and how much this bank is solvent. Okay? Now, so it started out as a financial crisis, and this is my next slide. It started out as a financial crisis, and then it became very quickly a debt crisis because many of the financial institutions, banks, had to be bailed out by the government because since they realized big losses, if nobody helped them out, they would have become insolvent, and that would have been a much, much bigger crisis. So many of the banks needed government money, injection of government money. Some banks in some parts of in Europe, in the UK, for instance, they just had to be bought entirely by the government. So it started out that was a private debt initiated from the household sector, became a debt of the government, a debt of the banks, and the government had to bail out the banks. So that's what we are calling, in technical term, socializing the private debt. So it became a debt crisis. As it became a debt crisis, it became also a confidence crisis. People lost confidence in their banking system. People lost confidence where it would lead. Would I still be able to keep my jobs? Will be a big recession, and people started to worry about their jobs, and as a result, people even who had the wallet to spend the money didn't spend the money. So what happened was that the household started to deleverage those that had high debt because of the mortgage loan. Those who could afford to pay and consume, they didn't. And because of this confidence crisis. At the same time, and this is an iterative process, the growth has declined, or even went to negative growth in most of the industrial world. Partly because now everybody was deleveraging. The household sector was deleveraging. The banks tried to deleverage also because they were making losses, so they they became much more prudent. They had to provision for the bad loans, so they were not giving credit. So the credit actually, I will show some slides on that, were in many countries were actually declining. The credit given to the national economy, and the government, since the debt increased very much, they started also to deleverage, to reduce afterwards the deficit so that they can reduce the debt to sustainable level. So, and that also led to further weaken the confidence. So it was sort of a vicious circle. And that's what made this crisis very difficult to handle and very difficult to resume growth. So the next slide that I am going to show you is how debt actually has increased. And you can see that in the Eurozone, the red line, and also in the United States, the red line is the public debt, the government debt. And it started to increase. This perpendicular line is the beginning of the big crisis when a big investment company, Lehman Brothers, were let to go bankrupt, was not bailed out. So we sort of trace the beginning of one can trace the beginning of the crisis to that date. And you can see in both the Eurozone area and in the United States, public debt has very much increased. In the United States, it reached 100%, and within a few years, from 60%, it went to 100%. But in the Eurozone also, from about 70%, it went within a few years to 100%, close to 100%. This is a very, very, very rapid increase. Now, at the same time, households wanted to reduce their debt, obviously. That was more successful in the United States, as you can see the black line, the private sector that has been declining. In Europe, in the Eurozone, it was a little bit more difficult to reduce household debts, partly also because, as I will show it later on, the economy didn't grow as fast. Now, the next chart shows the performance of the economy. Look at in the United States, also a big drop in GDP growth. It's a negative growth, 4%. And there was a recovery, but then again, it started to decline. And it's only now that that the United States has started to grow. And the Eurozone, in the Eurozone, it is even deeper. The decline, the initial decline was even bigger, and the second blip was also much deeper, and the recovery of the growth is also much smaller. And then, if you look at the emerging markets to the right side, they have also shown a very similar pattern: a big decline, and then a bit of a recovery, just a bit of a recovery. So basically, the whole world suffered from this economic recession. Now, what were the responses of the policymakers? This slide shows the central bank response. Obviously, the first thing that every major central bank has done, very much reducing the interest rate to stimulate the economy. That was the sort of the orthodox response. You reduce interest rates when there is a big decline in an economy and unemployment increases. However, that was not enough. The economy didn't pick up. So central banks started to go into areas which they have never done before in modern times, that they started to buy government bonds on the secondary market, mortgage-backed bonds, agency bonds. Some have also bought even company bonds. They have extended the loans that they give to banks. Normally, they give very short-term loans. They extended this. So they looked for very unorthodox measures to inject money into the economy, because just reducing the interest rate wasn't enough. And I show you a couple of charts. this one is the Fed, and the top line shows the Fed's purchasing of government bonds and mortgage-backed bonds. You know, the mortgage-backed bonds, they always carry some risk. So in other words, central banks ventured into buying assets that carried a higher risk. However, what you can see, a very large part of this ended up back in the Fed, in the central bank, as banks deposit. Because banks either they didn't lend, either because they were became more conservative once they have burned their fingers, but also because demand was very sluggish. There was no demand for credit. No, as I mentioned, the confidence crisis. Even people had the pocket to spend the money, they didn't. And this is a very similar picture that you will see. I just glance through that what you have sent, the Bank of England. Are we at the Bank of England yet? Not yet. Here, the Bank of England, the same thing. The asset side is increasing. This is also mostly government securities, but at the same time, it has come back into the central bank in the form of bank deposits. Very same story in the Bank of Japan. A little bit different story in Europe. First of all, they did not buy so much government securities than those three other banks. They mostly lengthened the period of loans to the banks. But again, what happened is that the liabilities have also increased. And this chart, what it shows, how much money was injected in the world by these major central banks. It's about 16% of the total GDP in a short period of time. That was all trying to stimulate growth. However, as you can see, credit hasn't really increased. What you see here, actually, that in the United States and in all countries, the rate of growth of credit has actually declined. So the injection of the money into the economy didn't bring the results that was hoped for, at least not at the beginning. As a result of that, next chart, as a result of that, you can see that actually the rate of growth has remained very sluggish. Here the exception is, the United States. The United States is the one that had the fastest recovery. If you look at the Eurozone, which is the blue line, you know, it hasn't even gotten back to what it was prior to the crisis, to the 100 base. And if you look at unemployment, again, unemployment has started to decline in the United States, just because it's also the fastest growth. And but it is very in the Eurozone, for instance, it's in double digit, 12% right now, and hasn't really started to decline. And in some countries, like Spain, the unemployment is 25%, and the youth unemployment can reach over 30%. It's a very, very big problem. Now, you wonder why the United States has done better than the Eurozone. Well, one answer is this. The United States is like a big aircraft carrier with one captain. The Eurozone is 15 destroyers with 15 different captains. So that's much more difficult to keep them in line because there's always one country or the other that would like to go in a different directions. That's one of the important thing is that the European Union and the Eurozone, it's independent countries with independent fiscal policies, independent parliaments, independent governments, and it's much more difficult to to get them follow the same policies overall. But there are a host of other reasons why the United States is doing better. One, it is that the United States is a younger population, mostly because of the immigration, while Europe is an aging population. So you can see that for an aging population, the pension, the social benefits, etc., become a much heavier burden. Add to that the social social net in Europe it's much wider than in the United States. So that's one other things. Because the expenditures are much higher, your taxes have to be much higher. So the tax burden is much higher in Europe than it is in the United States. A third element is that the United States is one big continent with one language, very similar institutions across the states, and vast resources, natural resources, and another very important element is that the United States is at the edge of technology. That's a very big advantage for a country that is always at the edge of the technology compared to a country that is adapting, even if it is fast adapting the new technology. The country that invented that new technology has always an edge, and the United States is that one. So there are many reasons why the United States is coming out of the crisis faster than Europe. Let's now turn a little bit to the Central and Eastern European region and the Central and Eastern European countries. And here I just showed the GDP growth. And I've sort of put in two different panels, the ones that are doing a little bit better and the ones that are not doing as well as far as GDP growth is concerned. The ones that are doing better, that you have Romania, Slovakia, Poland, Hungary, and the Czech Republic. What you can see here, it's two things that I wanted to point out. One is that a very well-performing country is Poland. Poland has many advantages compared to the other countries. It's a much bigger country. It's about the population-wise about the size of France. So they can live on their domestic market, while the others are mostly export-driven. And since about 75% of the exports of these countries go to the European Union, mostly to Germany and the other, France and UK, and since they were not doing well, so the exports, although growing, not growing as fast as before, and not having a domestic market that can be an engine of growth. So Poland has a domestic market that can be an engine of growth, and there are also good economic policies. So of course, that also plays a role. But the other point I wanted to make is that here is that with those exceptions, and the other exception is, if I see it correctly on this line, is Slovakia. The other countries are just now where they were prior to the crisis, the level of GDP, and even the Eurozone, which is in blue, is just where it was before the crisis. And then in this other panel are the Baltic states and Bulgaria and Slovenia. They had a much bigger dip also, a much bigger dip. As a result, they are coming back much more slowly, even though it's fast, for instance, in the case of Latvia, but it went down very much. And as you can see, they are still below what they were at the where they were at the beginning of the crisis. So this shows really the very heavy impact of the recession, which did not start in Central and Eastern Europe. It started in the U.S. and was coming over to Western Europe. The Central and Eastern Europe didn't have this toxic assets, what what I was talking about. Their banks didn't have. But many of these banks are branches or the daughter banks of their mother banks who are in Western Europe or in the United States. And they had their problems back home. So that has had an impact on their operations in Central and Eastern Europe, even though those banks specifically there didn't have those toxic assets. Now, let me see the next chart, which is, well, it just shows, you know, how big the unemployment issue is. And again, the countries on this right side panel that had the biggest drops in GDP had also the biggest increase in unemployment. And as you can see, the unemployment levels are very, very high. On the right-hand panel are, you know, double-digit, and even in the countries on the left side panel, some of them are double-digit unemployment. So let's look at the future. What I jump this. What are the prospects of the Central and Eastern European countries? One is that these countries are on a catching up path, catching up toward the rest to the Western Europe. And the reason for that is that the productivity in these countries is still relatively low, because coming out from the communist regime, there are still relatively low levels of productivity. So therefore, the possibility of improvement is very big, and they can import, and they do import, the latest technology. So productivity will grow fast. They're also a very highly trained and educated labor force, which is relatively cheap still. So that's also an advantage. You know, there is a regional cooperation that you might have heard about it among Czech Republic, Poland, Hungary, and Slovakia, which are called the Visegrad 4 countries. Visegrad is a city, a former royal city in Hungary, where they met, and so they have called the Visegrad Group. And there is a cooperation in economic development, and that also is something that is a positive contribution to possibly to faster growth in this area. Now, having finished that part of my presentation, I would like to talk about two things now. One is the Transatlantic Trade and Investment Partnership negotiation, which we call TTIP. This is a negotiation between the United States and the European Union to free trade, but also to liberalize services and also to harmonize regulations. It is estimated that this free trade agreement will contribute anywhere between 1 and 1.5% of GDP on growth on both sides of the Atlantic. So this is a very, very important event. The negotiations started last year, and it is hoped that it will be finished in about 2 years. There is a very strong commitment on both sides of the Atlantic to bring that to a conclusion. However, as you know, the devil is in the details, and as they are getting down to the nitty-gritty, so it's becoming a little bit more complicated and more difficult. But the decision, the commitment is there on both sides, and then you will see that it has to be approved by Congress, and I'm sure that the Congress, there will have to be doing a lot of lobbying, and it will be difficult. And also it will have to be approved by the European Parliament in Europe. So it's not it's not going to be a very, very smooth ride, but everybody hopes that it will come to fruition at the end, and it will help very much the trade between the two continents. And to show something interesting about the state where you are here, Utah, there was a study done that showed for every state in the United States what benefits they will draw from TTIP. And it turns out that Utah is the state where the share of the EU in Utah's exports is the highest, 37%. You know, the dark green are where it's about over 30% or so, but it's the highest, as far as I could read out, and I looked at it, it's in Utah, which means that Utah will benefit proportionally the most from a free trade agreement because its exports to the EU are the largest. And so that's an interesting feature of the TTIP as far as Utah is concerned. Now, I stop here because I would like to be able also to answer a few questions. So thank you very much so far, and please don't hesitate to ask me any questions.
So we do have time for a few questions. We have a microphone here on the side. You have to steel yourself, and please come on over and line up. You can form a line. Tell us your name and what you're studying, and like I said, we have about 10 minutes for questions. So, first question is always the hardest, but you'll always get to ask it. So, be brave.
I don't mind if you ask it in Hungarian.
I guess I'll take one for the team. Go first. My name is Michael Boyles. I'm studying political science. I was recently on the Model European Union team for BYU. We had a competition. I was working on immigration issues. And I was just wondering, with economic growth and everything, trying to get the economy jump-started, what role do you think immigrants can play in that, in helping the economy in Europe to grow?
The immigrants in Europe?
Yes.
Immigrants from outside from the European Union or within? From the outside of the European Union. At one point it will come. It's not as relevant than in the United States because there are fewer opportunities, of course. But there is, particularly now, from the Indian subcontinent, mostly going to the United Kingdom because of their traditional relationship, and from North Africa going mostly to France and Belgium, for instance, and Turks were very important, mostly in Germany. They do play a very important role because, like in the United States, sometimes they go into areas of jobs that the citizens of that particular country are not taking or not willing to take. Then there is also still outside of Europe from the former Yugoslavia, but they mostly go, their destination is obviously where there is room for finding jobs, and that's Germany, France, the UK, the Nordic states. Interestingly enough, lots of, but this is already within the Europe, but at one point within the EU, but it wasn't even before in the EU. Many Romanians went to Portugal because of the language. The Romanian is a Latin language, partly a Latin language also. So it plays a role, obviously. It fills in jobs that otherwise would not be filled. But then when there is a crisis, then, you know, unemployment increases, and very often unemployment hits those immigrants, partly because often there are in, for instance, in construction, work, and construction is in a recession, the first one that suffers from the recession.
Thank you.
Hi, I'm Alex. I study economics here at BYU, and I'm interested in your experience at the IMF. What were the main things you felt like you learned working at the IMF with regard to kind of the world economy and how we grow together as a world economy?
Well, you know, the IMF is a perfect place to be if you want to have a look all over the world economy, because practically all the countries are a member of the IMF, and wherever you work, you get involved in many countries, analyzing, going on mission to countries in different parts of the world, and so you gain an experience in that. And the IMF actually obliges you to rotate within the institution. So you go from the Asian department to the European department, the regional departments, African departments, Latin American department, and then you have horizontal departments like fiscal departments, that fiscal issues across the globe, monetary departments, monetary policy across the globe. So you know that's how you learn. I myself have been in several dozen countries over my career. And that's a very, very useful experience.
All right, thank you.
My name is Andrew. I'm studying economics and political science. You mentioned that one of the reasons that the U.S. was able to recover more quickly than the Eurozone was because it was more unified, or it was less, or the United States is more unified than the European Union is. In terms of culture and institutions. Do you believe that the European Union should become more unified, and if so, how, in what ways?
Well, the European Union will always maintain each nation, its cultural, language, identity. That's very big. History has been like this. The languages are also very, very different. So there will not be a unification, and it would be bad if there were unification, because you know this adds to the diversity of Europe. Whether how much Europe will go toward a greater integration, not just economically but politically. This is something the future will tell. Right now, because of the crisis that has impacted in different ways the European Union members, there is a tendency of many nations to think that less integration maybe is better, political integration, I'm talking about that, while before there was the drive to have more political integration, but that might change over time. Right now, the prevailing view is that less political integration. However, trying to liberalize internal markets, because services are, for instance, not liberalized. So there is still a momentum to integrate more economically, but less politically.
Okay, thank you.
My name is Taylor. I'm a political science major. Do you believe that with the aging European population, the broad social net will become a barrier to long-term growth, or do you think it will help European Union growth to be better in the future?
Well, if it's the population continues to decline, it's definitely a barrier, because fewer and fewer working people will have to care for more and more non-working people, obviously, and that's the only way to do that is to increase taxes. Get into debt, and after a while you just increase taxes, and if taxes are very high, this is a drag on growth. So definitely. So how the countries' responses to this is, some countries, like Hungary, are trying to encourage birth rate by providing benefits for those who have larger families. But everybody is trying to trim back on social benefits. Increasing pension age, for instance, is one. Reducing the benefits, the pension benefits, in a very progressive way. The U.S. is facing the same thing, but to a much less extent. So yes, yeah, that would be a drag.
My name is Leah Darrington, and I study international relations and economics here at BYU. At the beginning of your lecture, you discussed how the crisis began in the United States and then spread over to Europe. Do you believe that we should take this as a learning experience, as the negative effects that can happen between economic interdependence, or do you think that the positives of what can happen whenever we open up trade outweigh the negative effects, like this large crisis that swept through Europe?
Well, a crisis is always an opportunity also to improve on policies. And, you know, the reason he was overborrowing, you know, and one would have to avoid that in the future. And I think the lessons are to be more careful with regulation so that banks would not be encouraged to go into lending that clearly is unsustainable. Obviously, that's something. You know, there are two types of investors in the world. One that who have a short memory, and those who don't have a memory at all. So we have to be. So you cannot count on people that their behavior would change if it's not managed by the policymakers, and here I'm talking about regulations and how to conduct monetary policy and how to conduct fiscal policy. So that's the answer to that.
All right, thank you.
My name is Amy Prittis. I'm studying law. I have a more personal question at the instigation of someone. I heard that you grew up as a refugee, and I'm just curious a little bit if you could tell us a little bit more about your background and your road to where you are now.
Well, you know, I was born in Hungary, and I lived under communism until I was in high school, and then in 1956 came the revolution, freedom fight against Soviet occupation and against communism, which was, of course, crashed by the Soviet army, and then I left Hungary, became a refugee, but there were about 200,000 people who left at that time in a short period of a couple of months, and finished high school in Austria, went to Belgium, where I got my PhD in economics, and then I came to the United States and worked for the IMF for 27 years, and then I went back to Hungary right when there was the fall of communism, and I've stayed in Hungary ever since.
Awesome, thanks.
Edward Hausman, European Studies major. Először köszönjük szépen, hogy ide jött hozzánk beszélni az európai gazdaságnak az állapotáról. Nagyon ügyes volt. Most kérdezem angolul, mert szerintem ügyesebben tudom mondani azt, amit akarok. So, as far as my knowledge, I mean, Hungary is still using the forint. And I know they've had plans to move into the Eurozone and actually adopt the euro as its currency. Can you explain more about the plans and even the benefits of doing so, and maybe some barriers that Hungary has run into in doing so?
Yes, I believe that for a small open economy like Hungary, as integrated as it is trade-wise and financial, capital market-wise, into the European Union and into the Eurozone has an advantage to be within the Eurozone, because you eliminate basically an exchange rate risk, which is an impediment to when everything goes well. It's an impediment to growth because it is reflected in higher interest rates and bigger uncertainty, etc. However, you can follow good and bad policies within and without the Eurozone. If you follow good policies, then it's better if you are within the Eurozone for the reasons that I just mentioned. If you follow bad policies for some reason, then it's better if you're outside. It's better for the country because it has more flexibility to deal with its bad policies. And it's also better for the Eurozone. But it cannot be a goal that you follow bad policies. So at the end, this is why I'm saying, following good policies, and you should be within the Eurozone. Now, to enter the Eurozone, you have to satisfy the so-called Maastricht criteria. These are criteria that were accepted in a city in the Netherlands that is called Maastricht, which has rules that that before entering the inflation, how much should be your inflation rate, what should be your interest rate, what should be your fiscal deficit, which is below 3% of GDP, your debt, 60% of GDP or going toward 60%. So first of all, you have to satisfy those. And for instance, we don't satisfy the debt criteria. But now that the crisis happened, the jury is out that which countries did better, those who were within the Eurozone or those who were outside of the Eurozone. So now there is a debate when one should enter the Eurozone. Clearly, the best time to enter the Eurozone is when the economy is normal growth, etc. When you have a crisis, it becomes difficult, both on the countries that want to enter and also on the part of the Eurozone members who want to accept under those circumstances. So now, you know, for instance, in the case of Hungary, we are saying, well, let's see, but it's certainly a few years from now before we can seriously consider it. That said, Latvia became a member of the Eurozone just this 1st of January. So, you know, it depends. Latvia has accepted a lot of sacrifices. As you could see, what was one of the countries that had the biggest drop in GDP and a very high unemployment. But they're a very small country, and they decided that, you know, this is better for them to be within the Eurozone.
Thank you.
Thank you.
Thank you for your questions. And